last two slides here, I'm just going to talk about CapEx. That's an incurred cost that CapEx and OpEx. In this case, it's some sort of cost to drill or acquire an asset. And I say properties, buildings, processing plant, could be a wellbore, but anything that is on your balance sheet as an investment as opposed to an expenditure. It's called capital expense, commonly referred to as CapEx. It's also taxed differently. And then OpEx is the expenses incurred through the normal course of business. Might be wages for staff, could be chemical usage on your producing wells, it could be electricity to run your rod pumps, whatever be the case, that's an OpEx. And then we wrap up finally with taxes, ad valerums. It's a tax based on the assessed value of an item. In this case, in our oil and gas business, it's a taxed value, assessed value of an oil well. And it may include the surface equipment, pump jack, tanks, heater treaters, but it might also include the value of the reserves in the ground. Ad valorem is Latin for according to value, and it's also hard to understand because it's levied by local jurisdictions, school districts, maybe municipalities. It's often billed once or twice a year, usually in February after the county makes their assessments, send out bills based on the value, and your ad val taxes are due. It ranges anywhere from, actually, North Dakota, we have a 0 ad valorem tax. We have a higher severance or production tax. And then here in Colorado, our ad val tax is subtracted from our severance tax so that we're not double paying taxes. But anyway, the second bullet point, a production or severance, meaning you've severed the mineral from the ground and sold it. So a severance tax. It's some tax imposed on the extraction of non-renewable natural resources. That's why water, when it's produced, is generally not taxed because it is and can be renewable depending on the aquifers, etc. But oil and gas, coal, uranium, gravel, these kind of things are taxed at some sort of severance. And depending on the state, sometimes it's both, but often it's value or volume. So in Wyoming, we pay on the value. So it's dependent upon commodity price determines our severance tax. Whereas in Montana, we pay taxes on the volume. So if we make 10,000 barrels of oil, then the state says they give us some number for the year to multiply it by in dollars per barrel, and boom, there we go. The last bullet point, and that's the end of these slides, is income tax. And my note says roughly half of the countries around the world have some sort of income tax on hydrocarbon productions. And that's true, but why only half? Because not all countries in the world have hydrocarbon production. That's why. So any place that generally has hydrocarbon production, even Greenland has taxes, even though there's no hydrocarbon production in Greenland. You got to pay taxes. So that is the end of the notes. Again, like I repeated, or I told you at the beginning, not an awful lot in the guidebook. Most of these are more concept. Most of the data here is addressing what I think will be word problems coming to you on the exam. It could be a tax question, something to the effect, ad valorem taxes are typically associated with school districts. Well, you'd know the answer to that now. A severance tax taxes renewable resources. Well, the word letters non are missing, so read the questions carefully.